Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're diving into TeraWulf's Q3 2025 report. And wow, what a quarter. You've got this messy headline mess, right? But hiding underneath that was a massive $17 billion pivot that honestly changes the entire story for this company.
So let's get right into it. The headline numbers. Yeah, they looked pretty rough at first glance. But the real story here, the thing that actually matters, is this fundamental shift in the business. We're talking about more than $17 billion in new contracts that completely redraw the map for where this company is headed.
All right, so here's how we're going to tackle this. First, we'll make sense of those confusing headline numbers. Then, we're going to dive deep into this huge pivot into high-performance computing. After that, we got to talk about the new risks that come with it. And to wrap it all up, we'll give you our take, what we're watching for on the very next call.
Okay, so let's start with the numbers, the ones that really drove that initial reaction in the market after the report dropped. And this is a classic case of don't judge a book by its cover.
So the GAAP EPS, it was a huge miss. A loss of $1.13 when the street was expecting only a 4-cent loss. But, and this is a big but, this was almost all due to a non-cash accounting charge. Think of it as just paper losses from some warrants, not actual cash going out the door. Revenue also came in a little light. So yeah, you can see why these numbers might have spooked the market at first, but they really don't tell you what was actually happening operationally.
But now, if you just look past that headline miss for a second, check this out. Even though revenue was a bit light compared to what analysts wanted, it still shot up an incredible 87% year over year. That is a massive growth signal, and it's the kind of thing that gets totally lost if you just get stuck on the headline. And here, right here, this is where you start to see the new model actually taking shape. For the very first time, they reported revenue from their high-performance computing leases, HPC. Now, that $7.2 million might not sound like a lot, but it is the first real, tangible proof that this pivot away from being just a Bitcoin miner is actually happening. Okay, now let's get to the real meat of the story, because this is where it gets interesting. This wasn't just another earnings report. No way. This was the first page of a brand new chapter for them, all about AI and HPC hosting. Okay, get ready for this number because this is the one that changes everything. $17 billion. That's in new long-term customer contracts. Now, most of these are huge multi-year deals with a company called Fluidstack, but here's the kicker, the really critical part. They are all credit-enhanced and backstopped by Google. Yes, that Google. So you sign $17 billion in deals. You need a way to build it all out, right? Well, at the same time, they locked down over $5.2 billion in long-term financing to do just that. And management made a point to say the rates were incredibly attractive. That's absolutely critical because it means these projects are set up to be very profitable down the line. Listen to the CEO, Paul Prager himself. He flat out said it. He didn't frame this as a miss. He framed it as a total transformation of what the company is. From being this volatile crypto miner to becoming a stable, predictable infrastructure provider. So, we gotta pause here for a second and really understand this credit enhancement thing, because it's the key to the whole story. TeraWulf isn't just making a deal with some random startup. No, it's Google's guarantee on these leases that makes the whole thing work. That's what de-risks it for the banks and lenders, and that's what lets TeraWulf raise billions at those great rates. It's the secret sauce, the magic ingredient. And look, this whole pivot, it's not just about one deal. It's built on a whole foundation of these massive multi-year leases. We're talking 10, even 25 years out. This is what fundamentally changes TeraWulf. It takes them from a company that's tied to the crazy ups and downs of crypto and turns them into an infrastructure company with cash flows you can actually predict for years to come. So the big vision is out there. The money is in the bank. So now what? Well, the entire focus for investors, for the market, it all shifts to one word: execution. It's simple, really. Can they actually build what they promised to build on time and on budget? Management is calling this their repeatable end-to-end development model. Basically, it's their playbook. They've done it once now, right? They've gone from getting control of a site all the way to generating revenue. The whole investment thesis from here on out is whether they can just copy and paste that blueprint over and over and over again to hit their big new target of adding 250 to 500 megawatts of new capacity every single year. All right, so let's play devil's advocate. What could go wrong here? The risks haven't just vanished into thin air. They've just changed. The company's future now depends entirely on how they handle a whole new and pretty complex set of operational challenges.
From here on out, it really is all about execution. The risks you need to watch are things like, can they actually hit their construction deadlines? Can they keep their spending under control? How are they going to handle the, noisy accounting while they're in this transition phase? And what's the plan for phasing out the old Bitcoin mining stuff to make room for all this new HPC gear? These are the questions every investor should be asking now.
Okay, let's bring it all home. We'll wrap up with our forward-looking take and tell you exactly what we're going to be watching for in that Q4 report.
So, for our part, we're initiating coverage with an outperform rating, and here's why. We think the market is still way too focused on that headline GAAP miss. They haven't really wrapped their heads around the sheer scale and quality of this HPC transformation. In our view, the business has been fundamentally de-risked, and we just don't believe that's baked into the stock price yet. So for the next earnings call, the things to watch are pretty straightforward. First, look for a big jump in HPC revenue from Q3 to Q4, because they'll get to count a full quarter's worth. We're also expecting to see their profit margins improve as that high-margin HPC business gets bigger. The real catalyst, though, any updates on the financing for that big Abernathy project and news on any news sites they're buying up, which management kind of hinted could happen before the end of the year. All right, now for the fun part. Our outrageous but totally plausible trade idea. Let's pretend we're pitching this to the investment committee right now.
So here's the pitch. The whole play is a leveraged bet that the story around the stock is about to change. The thesis is simple. The market is valuing TeraWulf like a risky, volatile Bitcoin miner. But as they prove they can execute on these HPC deals, the market's going to have to start valuing them like a stable infrastructure company with guaranteed cash flows. When that happens, their valuation multiple has a ton of room to expand. So how do you play it? Long-dated, out-of-the-money call options. You're basically taking advantage of the market's short-term focus. And the catalyst that lights the fuse? A clean Q4 report that shows this HPC ramp-up is the real deal.
And as always, a quick reminder, this is not financial advice.